Hello everyone, my name is Austin Manning and I'm a wealth manager and certified financial planner with Raymond Gorell Wealth Management. Today, we'll be covering another valuable piece of your compensation as an Apple employee, the Employee Stock Purchase Plan, or ESPP. In this video, we'll explain what an ESPP is, the specific mechanics of Apple's plan, including the valuable look-back provision, how the shares are taxed, and the risks and strategies to keep in mind. If you or someone you know could benefit from this strategy or the other services our firm offers, feel free to contact our team for a complimentary consultation where we will review your financial situation to determine opportunities for optimization from an investment, tax, estate planning, employer benefit, and retirement strategy perspective. Now let's start with the basics. An Employee Stock Purchase Plan, or ESPP, is a benefit that allows employees to purchase shares of their company's stock, usually at a discount. Here's how it works. You elect a percentage of your pay to contribute, and that money is deducted from your paychecks over a set period of time known as the offering period. At the end of that offering period, the accumulated funds are used to purchase company stock on your behalf, typically at a discounted price. This discount is what makes an ESPP so attractive. Many plans offer a discount of up to 15%, which is an immediate benefit on the day the shares are purchased. Some plans, including Apple's, go a step further with what's called a look-back, which we'll cover in just a moment. Now let's take a look at the specific mechanics of Apple's ESPP. Apple allows employees to contribute up to 10% of their base salary toward the plan, subject to the IRS limit of $25,000 of stock per year. A key advantage of Apple's plan is that employees can purchase Apple stock at a 15% discount off the fair market value of the stock. Now, Apple runs two 6-month offering periods each year, one from February 1st through July 31st, and the other running from August 1st through January 31st. And here's what makes Apple's plan really stand out. It includes a 6-month look-back provision. The look-back allows your purchase price to be based on the lower of the stock price at the beginning of the offering period or the price at the end of the offering period. The 15% discount is then applied to whichever of those two prices is lower. When the stock rises during the offering period, this feature can push your effective discount well beyond the headline 15%. Now let's walk through an example to see how powerful this can be using the February 1st to July 31st offering period. On February 1st, the beginning of the offering period, the Apple stock is trading at $220 a share. By July 31st, the end of the offering period, the stock has risen to $270 a share. Now, thanks to the look-back provision, your purchase price is based on the lower of these two prices, which is the $220 February price. Apple then goes in and applies the 15% discount to that $220 purchase price, which brings your price down to just $187 a share. So even though the stock is trading at $270 on the day of purchase, you're buying it for just $187. That works out to roughly 30% off the total value of $270, well beyond the standard 15%. This is the real power of the look-back. When the stock appreciates during the offering period, your effective discount can be far greater than the discount alone would suggest. Now let's talk about how the ESPP is actually taxed. There are two layers to understand: the discount you received and any appreciation in the stock. The benefit you receive from the discount is taxed as ordinary income, and that tax is generally due when you sell the shares. Whether the remainder of your gain is taxed at the more favorable long-term capital gains rates depends on how long you actually hold the shares. To qualify for the long-term capital gains treatment, two conditions must be met. The stock must be held for at least 1 year from the purchase date, and it must be held for at least 2 years from the offering date, which is generally sometimes called the grant date. If you meet both of these holding requirements, it is known as a qualifying disposition, and a larger portion of your gain can receive the lower capital gains rate. If you sell before meeting those requirements, it is a disqualifying disposition, and more of your gain is taxed as ordinary income. It can help to picture the taxation in pieces. Your basis, which is what you actually paid for the shares, is not taxed again. The discount portion is taxed as ordinary income when you sell. and the stock's appreciation above that point can qualify for long-term capital gains treatment, provided the holding conditions are met. Now, before we wrap up, let's cover a few additional details worth keeping in mind. Like any investment, participating in the ESPP carries some risk. First, stock prices fluctuate. If Apple's share price declines, the value of your investment can decline as well. So it is important to weigh your risk tolerance in this current market environment before investing. That said, because of the lookback and the 15% discount, an employee who sells shortly after the purchase generally locks in at least a 15% gain, even if the stock declined during the offering period. Second, if you hold your ESPP shares rather than selling them, you can build up a single stock concentration risk by becoming overexposed to a single company. And third, there is potential for an unwanted tax liability if shares are sold without a plan in place. For employees looking to trim a concentrated Apple position in a tax-efficient way, strategies like direct indexing can help. By harvesting losses across a broad set of securities, those losses can then offset gains created by diversifying, potentially reducing or even neutralizing the tax impact. As always, the right approach depends on your full financial picture. We recommend reviewing these decisions with a qualified financial and tax professional, such as the team here at our firm. Thank you for joining us today to learn about the Apple Employee Stock Purchase Plan and how to make the most of this valuable benefit. Here at Raymond Gorell, we strive to serve as an effective one-stop shop for comprehensive financial planning. With over $1 billion in assets under management, our CFP and CPA professionals specialize in helping clients take advantage of financial strategies to materially enhance their ability to enjoy life before and after retirement. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today.